Current issues in financial reporting. Financial reporting is constantly evolving to address emerging challenges, regulatory changes, and advancements in technology. Accountants and financial professionals must stay updated on new IFRS developments, sustainability reporting, and the impact of digital transformation. This section will cover emerging trends in financial reporting, the increasing role of sustainability and ESG reporting, the impact of technology on financial reporting. 1. Emerging trends in financial reporting. A. Fair value versus historical cost accounting. Fair value accounting, IFRS 13, measures assets and liabilities based on market value, making financial statements more relevant. Historical cost accounting records assets at their original price, which may not reflect current market conditions. Debate continues over which method provides a more accurate and stable representation of a company's financial position. B. Principle-based versus rules-based standards. IFRS is principle-based, meaning it provides broad guidelines rather than strict rules. Some argue for a more rules-based approach, like US GAAP, to reduce subjectivity in applying accounting standards. C. Revenue recognition and complex transactions. IFRS 15 introduced a 5-step model to recognize revenue from customer contracts. Companies face challenges in applying IFRS 15 to industries with complex revenue streams, such as technology and real estate. D. Lease accounting changes. IFRS 16 requires lessees to recognize lease liabilities and right-of-use assets on the balance sheet. This change increases transparency but also affects companies with large operating lease commitments. 2. Sustainability reporting and ESG disclosures. With growing concerns about climate change, corporate governance, and social responsibility, companies are increasingly expected to report non-financial information related to environmental, social, and governance, ESG, factors, carbon emissions and climate risk disclosures, sustainability initiatives and corporate responsibility. A. IFRS Sustainability Standards, ISSB. The International Sustainability Standards Board, ISSB, was created to develop global sustainability reporting standards. These standards aim to integrate ESG reporting into financial statements, ensuring that investors have consistent and comparable information. B. EU Corporate Sustainability Reporting Directive, CSRD. The EU requires large companies to disclose detailed sustainability-related financial information. These disclosures are becoming mandatory, requiring accountants to adapt new reporting frameworks. C. Greenwashing risks. Some companies overstate or misrepresent their sustainability efforts in financial reports. Regulators are increasing scrutiny and penalties to ensure credible ESG disclosures. 3. Digital transformation in financial reporting. Technology is changing the way financial statements are prepared, analyzed, and audited. A. Artificial intelligence and automation. AI-powered tools help automate data entry, fraud detection, and financial forecasting. Reduces errors and increases efficiency, but raises concerns about reliance on algorithms. B. Blockchain and accounting transparency. Blockchain technology improves data integrity and prevents fraud by providing tamper-proof financial records. Potentially eliminates the need for traditional audits, but adoption remains slow due to regulatory challenges. C. XBRL and digital financial reporting. Extensible Business Reporting Language, XBRL, enables companies to report financial data in a standardized digital format. Many regulators now require XBRL filings, making financial statements easier to compare and analyze. 4. Future challenges in financial reporting. Harmonizing global standards. IFRS and US GAAP differences still create challenges for multinational companies. Efforts to achieve global convergence continue. The role of professional judgment. As financial reporting becomes more principle-based, accountants must apply judgment when interpreting standards. This increases the risk of inconsistencies in application. Cybersecurity risks in financial reporting. As financial data moves online, companies face risks of data breaches, hacking, and fraud. Accountants must ensure secure financial systems and compliance with data protection regulations. Test your knowledge. Multiple choice questions. Q1. What is the main goal of the IFRS Sustainability Standards, ISSB? A. To replace all existing IFRS standards with sustainability-related reporting. B. To integrate ESG disclosures into financial reporting for better investor transparency. C. To introduce new tax regulations for carbon emissions. D. To enforce penalties on companies that do not follow sustainability guidelines. Q2. Which technology is helping to improve transparency and prevent fraud in financial reporting? A. Cloud computing. B. Blockchain. C. Spreadsheet software. D. Paper-based accounting records. Q3. What is one challenge of implementing IFRS 16, leases? A. It eliminates the need for financial statements. B. It allows companies to remove liabilities from their balance sheet. C. It requires most leases to be recognized as assets and liabilities, increasing reported debt. D. It does not apply to multinational corporations. Leave your answers in the comments. Did you get them right? Let us know in the comments. Like this video if you found it helpful and subscribe for more ACCA, IFRS, and financial reporting content.